Good morning, everyone. We might make a start. For those of you that don't know me, my name's Anthony Murphy, and I'm the CEO and founder of Lucerne Investment Partners. And today I'm joined by Martin Robertson and Mark Evans from Hill Partners. Good morning, gentlemen.
Morning, Anthony.
Thanks for joining us today. Look, Hill Partners, for those that are attending today that we've already had a chance to speak to, look, it's a fund that we're really excited about. It's an investment opportunity that we see as quite different, and as we all know, Lucerne sort of prides ourselves on bringing different fund managers to the market that have an edge, but particularly in the fields in which they operate. And we think Hill is an absolute shining example of this. For those of you that don't know, Hill stands for Health, Education and Lifestyle. And I'll now hand it over to Martin and Mark to talk a little bit about their backgrounds, the backgrounds of why they established Hill, and then dive into the fund and portfolio itself, and probably have Mark talk about some of the investments, in particular as he sits on the boards of the underlying companies that Hill currently owns. So Martin, I might hand it over to you first, and we'll take it from there.
Yeah, thanks, Anthony. Good morning, everyone. I suppose at a very high level, Hill, as we mentioned, is a health, education and lifestyle focused growth stage fund. So we are scale up, we are not startup. And if you look at our current portfolio of seed assets, at the bottom end of the range on a run rate basis, it's doing about $20 million, and at the upper end, it's about $110 million of run rate revenue. So that gives you a sense of the scale of businesses and the stage at which we invest in. So we're not a VC model, which may look at doing 20 deals in a portfolio, and a number of those will be zeros and a couple of winners. We're a very small, very, very focused, disciplined approach in terms of our portfolio. So we're looking at maybe doing another 2 investments in this first fund, so a total of 6. We launched last year in September with 3 seed assets on day one. And I suppose that is somewhat unique for most private equity funds, which are typically blind pool funds. And it may take them 3 or 4 years to invest the fund's capital. So we launched on day one with 3 seed investments, being Edge Early Learning Centres here in Australia, the Removery, the world's biggest tattoo removal business, and the Fertility Partners in Canada, which is the largest IVF platform in that country. And Mark Evans will talk a bit more about those in a moment. Just a quick background on myself. I've just returned to Australia after about 20 years away. I was in Asia for the last 16 years, predominantly doing private equity in healthcare. One of the major things I was involved in was the acquisition of a small group of hospitals in Vietnam. And as chairman of that group, over a 5-year period, we took that from 5 hospitals to 16 hospitals, from a million patients a year to almost 4 million patients a year, and from $10 million of EBITDA to $50 million of EBITDA. So essentially created $1 billion business in that 5-year period. I was also involved with Halodoc, which is Indonesia's leading telemedicine and drug delivery platform. I was on the board there for a number of years. And that is, we think, the next biggest thing coming out of Indonesia. It's invested by the Gates Foundation and a number of the other big Singapore Inc. Investors. But I suppose one of the investments that I did, in my time in Asia is really, for me, the genesis of Hill. So back in 2010, I led a $100 million round into Dental Corp in Australia. And Dental Corp was one of the most successful roll-ups, I suppose, in the healthcare space in Australian history. And Dental Corp was founded by Mark Evans and Chris Chambers. And Peter Chapman from Asia Principal Capital was advising them on that transaction. And today, the 4 of us, I suppose, are 4 of the 5 members of the investment committee of Hill. And so that's really, I suppose, how we all know each other, going back at least 10 years, in some cases 15 years. And as I think you'll hear from Mark today, we really are a team of business builders and operators, and really bring a hands-on active management model to all the businesses that we invest in, the management teams that we partner with, and things like that. But I think, spending a few minutes with Mark on the Dental Corp story is an important place to start, because that business model and that approach really informs a lot of the DNA in terms of how we look to operate at Hill. So Mark, maybe over to you for a background on yourself and Dental Corp.
Yeah, thanks, Martin. Hi, everyone. I guess Melbourne, born and bred, first 20 years of my career in investment banking, sort of M&A, IPOs in the mid-cap sector of the market, also shareholder and director. And I guess my first business we built was a stockbroking firm from sort of one office to six offices around the country, one of the largest sort of private client corporate businesses back in the late 1990s. Decided in the early 2000s to sort of jump ship. Enjoyed running businesses more than advising in the end, and so went out, set up my own business. The first transaction we did was a company called Kids Campus. This was in 2004, where, and sort of I guess this is also that leads into a couple of investments we've got now, but Kids Campus was effectively a roll-up strategy of childcare centres in Australia. We grew it. It was a listed company. We backdoor listed it straight away. We grew it from 4 centres to 110 centres in the space of 3 years. I have to say, I learned a hell of a lot, and I think it was sort of became what Dental Corp next became. I mean, we learned a lot about how to run remote location businesses. We learned a lot about establishing corporate functions to support growth. So that business was taken over by a larger operator in 2006, late 2006. At that point, Chris Chambers and I set up Removery Capital. The intention of Removery Capital was that we would invest our own capital and, I guess, management expertise into a number, sort of 2 or 3 fast-growing companies each year, take sort of active board roles. In the end, didn't quite work out that way. The one and only transaction we really did in the next 10 years was a company called Dental Corporation, as Martin said. You wouldn't necessarily know it. We kept quite a low profile. The big thing with Dental Corp was it was in the background supporting our dentists rather than being the public brand name. By the time we left Dental Corp after over 10 years in Australia, we had about 8% of the Australian dental market, and Canada a higher percentage, again around 12 or 13%. But I guess the thing that we carry through today and was the critical part of the success of Dental Corp, and I think all markets around the world are also littered with some professional consolidation / roll-ups that haven't gone that well, was a partnership model. And look, it had the basis I'd always effectively, albeit within a corporate environment, worked for myself, being a shareholder. I think it's very difficult to take someone like a dentist, a doctor, accountant, a lawyer, anyone really who's been used to working for themselves for a long period of time, and then saying, hey, here's a corporate, come in and we're going to tell you what to do, what hours to work, and take away their independence. And that was the genesis of what we did at Dental Corp. We grew it from 1 practice in Sydney in 2007. Today that business has over 500 practices in 3 countries, Australia, New Zealand and Canada. Well over $1 billion turnover, 5,000 staff. It was incredible, I guess, success. I think we changed people's lives, and the dentist and that management philosophy that we've got continues on within that business. We sold the Australian business to Bupa, who approached us after Martin had invested some money in the business as well, as he said, in 2013. Stayed on managing it under Bupa's auspices for a number of 3 years at that stage. And I guess really the reason Heal is happening in some ways is Bupa, the only country in the world that they really weren't involved in, was North America. So our Canadian business, in the end, a couple of years after Bupa bought the business, we sold off to private equity. Dental Corp turned its $20 million investment into $200 million. The next investor who bought us out for $200 million turned their investment into $1.2 billion over 4 years. And it was sold to an American private equity business in 2018. So I stayed on the board and as executive director of that business until 2018 and left at that point in time. So look, I think we learned a lot. Our strengths are building culture within businesses, empowering people to be their best within a corporate infrastructure, and providing support for the people operating and running the business. We don't franchise, though. We do take ownership and responsibility and really partner with our professionals on the way through. So I guess that then leads into the other investments that are in Heal and the establishment of Heal. I think we with Martin and Pete and Chris decided 12 months ago to set Heal up really to take those capital positions in businesses that have grown to the stage that Martin said before, and really sit in that that second round funding position, but we are active investors. I think we want to do limited deals. I am executive chairman of both Removery and Edge, and we're very hands-on, and less so in some of the other investments, but certainly with the active director roles supporting management to help them grow. So just to quickly go through each one of the investments for you and sort of the current market position, and happy to take questions. Edge we set up in 2017, really went back into the childcare space at that point in time based on growth. A little bit of a unique model. We're Southeast Queensland focused, so very geographically focused, also development focused. So of our 21 existing centres, we have developed ourselves 3/4 of those, but we don't take the freeholds onto our balance sheet. We've got partners, funding partners for who fund and hold the freeholds, but we are an operator who is very focused on fantastic facilities in great locations that we can create ourselves. So we've got market leading facilities and very focused on staff growth and welfare. We partner with our centre directors, albeit their employees, and empower them to run their business. The childcare space in Australia is probably one of the leading markets in the world. The government is certainly committed to early childhood education, and I think that's the main issue here, and the opportunity is that tailwind is now, I think, wide recognition around the world of the importance of the education piece in under 5-year-old kids, and the fact that they need and certainly benefit. They learn more by the time they're 5 than they do in the years afterwards, and so a structured learning environment is of critical importance. And I think through COVID we saw growth in that business still, while more people are working from home. I think a lot of people realise that it's pretty difficult to work from home with an under 5-year-old child in the same house, and so we saw continued growth in that business. And right at the minute we've got a number of opportunities in front of us to continue to grow. The plan is to get to 50 centres in that Southeast Queensland market, which gives us a good market concentration, and potentially look at a couple of other markets in concentrated markets in the Australian space as well. So growing, profitable, and I think great market position as a leading provider in Southeast Queensland.
And Mark, what's your exit with something like that once you get to 50 centres in Southeast Queensland?
Yeah, good question. I think that, look, there's a number of opportunities. The listing is one. Private equity is certainly looking at the space at the moment quite significantly. I think because of the level of government support that's in there, they see it as a bit of a safe haven in a COVID environment. I think there's also an opportunity which is probably straight in our wheelhouse as well, potentially to merge us with a number of other similar sized groups that are out there in separate geographic markets to create sort of an eastern seaboard or Australia-wide business that's got larger valuation. But there's quite a bit of activity at the moment in the market. There's a public company, Think, that's being under takeover offer from a number of buyers, and there's a business in New Zealand that's for sale that I know has got very strong interest at significant multiples as well. So I think it's been a positive. I think the other big part of the tailwind potentially behind it is that the government, I think certainly the opposition has made their policy that they want to see more money into early childhood education and potentially making it free for parents. There was a period through COVID that the government made it free. We certainly saw a jump up in occupancy there, and I think you'll see more funding coming into the sector, both from the economic benefits of two-income families being able to work, providing support, also through to that, as I said, that education benefit as well. So it's an interesting space at the moment. We've had a number of people knock on our door to see if we're interested in doing a transaction. I think we've got a very good board that's focused. It's an industry that doesn't necessarily have a corporate-minded focus at board level at times. Sure. So I think there will be that sort of opportunity. So that's Edge. Removery, I have to say, is once again, we sort of fell into this one a little bit in the sense that we were looking at the next project to do once Dental Corp had finished, identified tattoo removal as a market with sort of almost unlimited white space and growth potential out there. We're really looking at doing it in Australia, ended up going to the States to have a review of what was going on over there, and like I think he's Victor Kiam, wasn't he, the guy who bought the shaver company? We ended up sort of buying the business and growing it. Removery, it's an amazing business. 50% of the population under 25 in almost every developed country in the world has a tattoo. Every study sort of says 40% of people will admit to regret of their tattoos. Personal taste and changes over time. What you do in your early 20s is very different to how you feel about yourself or what you want to be perceived as when you're in your 30s and 40s. Tattoos have been growing and continue to grow exponentially in terms of popularity, becoming very much body art, as well as the days of the tribal tattoo have gone. Tastes are changing quite dramatically as well, which all leads to a bigger market for removal. The interesting piece, and I think why we're easily the biggest in the world and got significant growth opportunities, really is that the technology has changed dramatically over the last 5 years. Really 3 years ago, with the sort of or the finalisation of the Pico wave technology, we can now basically remove any tattoo without scarring, without discoloration of the skin. And that's a relatively new thing. There are some, going back 5 years, the technology wasn't as good. The big opportunity now is just to really increase awareness. It's still amazing how many people out there, A, don't know that laser tattoo removal works, B, that it's available, and C, that they will act on their regret or their change. So at the moment we have 42 clinics in the US. We just acquired a couple in California, so we're now from coast to coast. Our plan is to grow that to over 200 across North America in the next 3 to 4 years. We're seeing significant, year-on-year growth despite COVID as well in the business, and we've got a very full pipeline of acquisitions and de novo. From here on in, there's limited acquisitions to go. So I think 80% plus of our growth will be de novo / greenfield new store openings. The margins are fantastic. We can sort of open a new store, including the lasers, for between $400,000 and $500,000, depending on fit outs. We're just taking leaseholds. And really, within 12 to 18 months, sort of expectation of $300,000 to $400,000 EBIT out of those clinics. We have spent 18 months professionalising the marketing, putting call centres in place, professionalising support services, and are now in a position to really put our foot down to grow that business. With COVID as well, we're now opening in Australia. So we open our first store in Australia next week, looking to have sort of up to 25 or 30 clinics here over the next 12 to 18 months. There is no global player in the tattoo removal space, and we think there is opportunities, certainly in Europe as well, albeit at the moment we're very focused on building a fantastic business in the US. It's I think the opportunity, and I guess our business plan model there is to normalise tattoo removal. The store we're about to open in Australia is in Eastland Shopping Centre, so it's a sort of a Westfield style mall, next to a clothing shop. People walk by, look up, and we're moving all our locations into retail locations. We see this as an opportunity that within 3 or 4 years, when people are having a tattoo put on, that tattoos will no longer be for life, and they'll be going down to their local removery in 10, 15 years time, potentially even having guarantees that when you have your tattoo put on, you can have an arrangement if you want to change. The interesting bit probably is 30% of our customers aren't just having a tattoo removed, they're having them removed to have new ones put on in their place, and that's that dramatic change in taste and culture that's going on at the moment. People say, look, what happens if tattoos, at the moment you almost can't get into a tattoo shop post-COVID to have a tattoo put on. I think people are sort of focused very much on themselves a bit more at the moment. If tattoos become less popular, then there's going to be a whole lot of people now out there that have got tattoos that they think is part of an interesting culture that will want more removed. So I think we're hedged either way. If tattoos keep growing like they are, there's going to be more and more people who want tattoos removed, and if they're not as popular, there'll be more people who want the tattoos removed because they're no longer part of the fad. So Critical success factor in that business. I know where those 250 stores are going to go. We can fit them out. We can plug the lasers in. We've just raised a significant amount of money from Elliott Investment Management in the US, so we're well capitalised post the Heal investment to grow. It's now all about training the right people and getting them into those stores. So,
Mike, do you just want to talk a little bit about Elliott coming in, because that's pretty significant, right?
Sure. Yeah. So we
maybe just for the viewers who Elliott actually are.
Yeah,
as
so
well.
Elliott are a $40 billion hedge fund in the US, active. I guess they're best known as an activist investor. I think a few of you go back a few years, they took on BHP and a few others in regards to some of their public disclosures. We ran a process through Jefferies over in the US. Heal made an investment in the middle of last year and ran a process. We had a lot of interest, and in the end, Elliott, and so they invested 50 million US into the business for a 25% shareholding in early 2021. And look, they've got a couple of board seats, good supportive investor, but we're still running and continue to run the business. The day-to-day management of that business is based in Austin, in Texas, and the business is run by a couple of ex-Dents, so the chief operating officer from Dental Corp in Canada and the chief operating officer from Dental Corp in Australia are running the day-to-day operations of that business in the US. So look, incredibly exciting global opportunity, great margins, no competition at the moment. The competitions are mums and one-off mum and dad type shops. I think we have quite a unique opportunity to create that Removery becomes synonymous with tattoo removal in a growing space. Another big competitor may be an advantage to help us with the heavy lifting of increasing awareness in the market, but I think there's no sign of that at the moment. We almost have the market to ourselves, which is a nice position to be in.
Just on the consumer experience, Martin touched on this the other day. But when you walk into that shop for the first time, what is that experience until that tattoo is removed?
Yeah, sure. I mean, that's so on average it takes, so just so you understand the technology, basically the laser breaks the ink particles down, shatters them. So you're sort of breaking the ink particles from boulders to rocks to stones to sand. And once they get the sand-sized particles, the lymphatic system naturally removes the ink. The interesting thing about tattoos, it's a bit like a car. The day your tattoo looks the best is a couple of weeks after you've had it put on. The body then starts to naturally eat away at the ink and fade it anyway. So we're just accelerating the natural process effectively. So it basically takes 10 visits, 6 to 8 weeks apart to have the tattoo removed. The time under the laser is quite short, for a playing card size tattoo. You're probably under the laser for 30 seconds. People talk about, does it hurt? I've actually had a tattoo put on to have it removed. So I'm in the process of my removal. It's a bit like a rubber band being flicked against your skin. But I guess our stores, and happy to show anyone who's interested some photos. But very much like a relaxed dental surgery type vibe, sort of more some throw rugs on the floor, but very much a retail feel. We offer financing. Most of our customers will pay for a guaranteed removal. So they'll pay up front for those 10 visits. If it takes us more than 10 visits, then we continue to treat them. On average, it costs, for that playing card size tattoo, costs about $2,000 to have removed. So on average, about $200 a visit for a 15-minute appointment. I think the thing that puts a moat around what we're doing is that, and one of the bits I really like about the business as well is there is an art to removing a tattoo. Different colours need different wavelengths on the laser, different colour ink, that is. And so it is a bit of an art form to remove. We're clearly, the underlying businesses that form Removery have been going for 5 and 6 years. We've got the most experienced people in the world to remove tattoos who are training up our new people. So it's more than just someone buying a laser and plugging it in to get results. And I think that does provide a strong barrier to entry for us. The lasers aren't cheap either. You're sort of talking this price over $200,000 a laser as well. So it's a commitment. You can buy cheaper ones, but the ones that effectively work. So yeah, customer experience. We're locating ourselves in easy access areas. someone like New York, at the moment, we've got 3 stores. Intention would be to have, 6 or 7. Chicago, we've got 4 stores. We can have 6 or 7 there. Toronto, same thing. Melbourne in Australia, we've got 1. We're about to sign a lease on another one. We'd have 5 stores in Melbourne. So 1 east, 1 south, 1 north, 1 west, and 1 central. So,
and price is not a deterrent. $2,000.
Yeah, look, price is always a deterrent. I think there is some people out there who can't afford the $2,000. Yep. We break it down the other way, though. I mean, we've run a lot of tests, and because our margins are good, we could reduce the price, but we haven't found that it's lifted acceptance substantially if we have dropped the price. It's over 12 months as well. So, I mean, our payment terms, effectively, people can just pay it in monthly installments. And we put it as basically it's the cost of a cup of coffee a day to have your tattoo removed. But yeah, look, yes, potentially there are people out there who would have their tattoos removed if it was cheaper, but I think we're comfortable in the sweet spot that we're at. So that's Removery. Other ones. So the Fertility Partners is a business that we established in 2020 in partnership. Well, it was established by Dr. Andrew Meikle, who is our partner in Dental Corp in Canada. Andrew is a dentist. He was along with us when we went into Canada. We partnered with him and another chap to grow the business. Andrew recognised an opportunity in the fertility space in the Canadian market where, pardon me, unlike in Australia, there had been very limited corporate activity. And I think it's, in the space of less than 12 months, effectively, we now have 35% of the Canadian fertility market, which has been an amazing performance. It shows the strength of our partnership mindset mentality. The TFP model is almost identical to the Dental Corp model. We are approaching and partnering with fertility doctors, basically, who in the end, same as the dentists, spend their days at the moment seeing patients and then try and run what is a complicated, medium-sized business. At night, we're coming in, we're taking away the business management and freeing up their time and focus to focusing on their customer. The other real upside in that business is improving the customer journey. I think, Anthony, to talk about customer journey in tattoo removal, certainly in the Canadian market, at the moment, the marketing and the customer journey is run by the doctors more so than the marketing people. I think at times they forget what it's like, and it's a bit like going to no one wakes up in the morning and says, wow, fantastic, I want to go to the dentist. I think, the fertility process is very similar. We're seeing significant, growth in demand across the world for fertility services as people have children later in life. Business in Canada, we're now effectively Canada-wide, and all our doctor partners are shareholders in Fertility Partners. So the continued growth, we've got a number of other acquisitions that we're looking at there at the moment as well. And I think it's a global opportunity, effectively, because most of the other PEs that are in that sector are coming at it from a PE type mindset rather than a partnership mindset. And we've had a number of approaches from businesses outside Canada now to see if we're interested in partnering with them as a way to, help them both monetize some of the value in their business, number one, but number two, and probably more importantly, to help them manage and grow the business. They've got it to a point where, how do I continue to manage this large business? I think the success, I'm jumping around over here, of the Dental Corp model as well as the TFP model. I mean, we had a recontract rate in Dental Corp of over 95% of our doctors at the end of their first term contracts would sign on and continue on with us because we made their life better and easier and more financially rewarding because we managed to help them grow their practices. And I think Fertility Partners is going to be exactly the same circumstance.
So you're actually solving a problem.
Solving a problem for them. Yep. And it's not an exit for them. I mean, we're not there offering them exits. We're offering them a way, as I said, to monetize part of their holding, take some shares in a larger group, which should be worth more than their individual business in the end, and also help them grow and support their business. I think the unique thing in the Canadian market as well is that most of the training for the doctors is actually done in-house in the clinics as well. So we're also a training organisation, training our next group of fertility doctors to come through at the same time. So it's been an amazing 12 months and an incredibly exciting future coming up, I think, for that business that can grow to a bit like Removery can scale to a world-class and world-scale business. We've got good support between Heal and another private equity operation, another firm in Canada who are investors in there as well. And there's going to be some opportunities in the next 3 to 6 months to increase our investment on the back of a number of deals that are coming up there as well. So.
Yeah, and that was going to be on my question. So the capital that's coming in over the next couple of months, what portion do you feel is for the existing portfolio, and what portion do you feel is for those new 2 to 3 investments you'll be making?
Yeah, it's a good question. I think can I answer? I might quickly go through the last opportunity that I'll come back.
Sure,
to,
of course.
that question if I can. Sure. So that's Fertility Partners. The other investment we've made in the last couple of months is in a company called Higher Ground. So Higher Ground is the largest Montessori, and Montessori is I guess a unique, not unique. It's a early childhood education program, effectively. Operator in the US, so it's childcare again. They have 69 centres as in today in the US and 8 in China, I should say. They just did a Series C round, which we invested in, and then subsequent to that, they've actually done another round at a 50% premium to our last investment, which we followed on with that investment as well. I'm on the board of that business. They have incredibly ambitious growth plans. The market opportunity in the US is a little bit different than it is in Australia. Unlike Australia, there is very limited government support and funding for childcare. I actually believe that is a significant opportunity for the business because, as the recognition of the importance of early childhood education comes along, it's hard to believe that the US government can't continue to not fund childcare, and because of the importance of that education. But even as a standalone, this High Ground is operating, I think, probably one of the world's best early education programs, training its own staff, both growing through acquisition and conversion of existing centres into Higher Ground centres, but also growing through a greenfield development process, which obviously we're experienced at with Edge. So they've also invested heavily, and I think there's some opportunities to bring this to Australia through Edge, potentially into online education programs, which is very good for the US, where you've got a lot higher percentage of kids being homeschooled in that under 5-year group. And so they run a very deep and a comprehensive program of online education that either the parent can follow from home. They're also doing online classes where they'll have a teacher on the computer, as the kids do their activities. And this is all, it's all obviously age appropriate. It's not, you're not sitting behind a desk as a 4-year-old, but it's certainly teaching them language, music, physical activity. So it's a really impressive program. The business is growing rapidly, got a good range of support from a number of PEs in the US, and I think it's a business that we've got an opportunity to have a good level of involvement in and help them grow, but also there's some learnings coming back our way as well. So that's High Ground. There'll be more funding opportunities there.
What's their real point of difference? I mean, online education is not a new concept, right?
No, I guess it's coming from, they're coming from it in their most of their online education is focused on the under 5-year group. They do have some middle school and junior school programs as well. So it really is their point of difference is that earlier age group, but very much, I think, focused, and they're coming at it. A lot of the online education I've seen has been more driven by, not driven by the real world experiences. And I think they're running the same programs online as they're running in their centres. I mean, their point of difference in the market and the bit is the Montessori approach and training and education does differentiate themselves. The majority of the business, and it still is the online piece is certainly a fast growing piece of the business, but the main focus is still the bricks and mortar schools and operating those.
So maybe Anthony, I suppose if we could just bring that back to the Heal story. So obviously hearing from Mark, you can see that we're a team of business builders, operators, very hands-on, active management model. We're not a private equity firm that's coming in with a command control type of perspective, telling our doctors or educators how to run their business on a day-to-day basis. And we're not a private equity group that's coming in to look to cut costs to drive margin expansion and achieve returns that way, nor are we using leverage to achieve returns. So it's about building and helping management teams build great businesses. If you have focus on your service quality and education and healthcare, you will enhance your brand, your reputation, you'll grow your business, and yes, over time you look to optimize your margins. And so I think bringing it back to our launch last September,
and you're doing a social good.
Yeah, absolutely. I mean, the social impact side of things is, I think pretty significant. So we launched last September. We raised $30 million from our high net worth backers from Dental Corp, in a pretty quick fashion, and put to work $25 million across Edge, Removery, and the Fertility Partners. And I think what really resonated with that investor group was, number one, I think what we believe in is the quality of the portfolio, but also the high degree of visibility in terms of where the fund will be invested. And so we are a growth and follow-on fund. So a large proportion of this fund will go in as follow-on capital into the existing portfolio. And as I said at the start, we'll probably look to do maybe 2, maximum of 3 other investments, alongside the existing portfolio. I think the other thing to sort of mention is that, again, we're not a private equity group that's looking to come in and on an auction process and outbid someone else. We are looking to use our network and our referral basis to come in and work with management teams and show them we can add value and hence secure sort of preferential sort of entry valuations. I think the one thing you can't undo in an investment is overpaying at the start. And so, our model is very much about securing preferential pricing. And I think we've already demonstrated that. So for instance, as we mentioned, High Ground, we came in, we sort of got to know them September, October, just when the Series C really was closing. We really extended that process and really sort of took a few favors there. Didn't close the deal until December. We did lots of due diligence. They were very keen for Mark to come onto the board. And as Mark mentioned, we closed the Series C in December, and they've just closed their Series D at a 49% premium to where we invested. Equally, on the Heal investment into Removery in September, Elliott came in 4 months later at a 24% premium to where we invested. And we're coming up to another round in Edge in Q2, which will be 100% markup. And the reason for the size of that markup is that we were able to acquire some shares from a distressed investor in September last year. So I suppose what that means from a fund perspective and from a potential investor perspective is we're coming up to our first close on the 31st of March. On the ordinaries, it's the original $1 price. We haven't yet marked up the fund, and obviously beyond the first close, that's the intention to do so. So I think it's a pretty unique opportunity for investors to come into a fund with existing assets, which are all performing very strongly, and where we've already had 2 material markups with a third one coming. And then the Fertility Partners is also going from strength to strength. When we bought that company, this time last year was doing a run rate EBITDA of $9 million, and it finished the year at 20. So, across the board, I think we're pretty excited in terms of where that portfolio is going. And I think
you mentioned just on buying well as well. There was I think another asset you mentioned today, Martin, that you're looking at the moment in terms of a new story for the portfolio in terms of valuation.
Yeah,
25.75 or something like that you were talking about the other day. Yeah.
So there's the next opportunity that we're looking to invest in, we're pretty excited by. It's founded here in Australia by a business associate of Peter Chapman's, one of our other Heal partners, that they go back 20 odd years. This founder has developed a business model and approach to dealing with compensable injuries in the health insurance market, and he's delivering 24% savings. The compensable injury market in Australia is an $80 billion market alone. He's now signed up contracts with the 4 leading insurers in Australia, who are all part of a global business group, and the opportunity in the US is even more significant. So whiplash, being one of the focus areas of this business itself, is an $80 billion market in the US as well. So they've had approaches from a number of people. We're we're securing an investment into that business at a material discount to where that market level of interest is. And the reason that we can secure those kind of discounted entries because they're valuing our input into that process in terms of strategy, referrals, partnership agreements, and all those types of things. So that's really our model, hands-on business model, limited number of investments in the portfolio. And, I think saying no to very good deals that we're seeing and only doing the very, very best. So since we launched, I think we've been referred about 90 investment opportunities. 10 to 15 of those we think are really high quality, but really we're looking to say, only yes to the one or two that we really think are the next big ones.
I think that's a good, that particular investment we're looking at now, we've worked with them for the last 6 months to almost get them to this point that it was ready for us to put the investment in as well. So, they want our involvement. And I think that's part of the opportunity. We're seeing so many, and look, we've been, it's interesting now, even in the last, month, approached by a number of people out of, big firms in the US who've seen what we're doing, to see if, we want them to come and work for us, and starting to see deal flow out of some interesting places over there.
Quality problem to have.
Yeah, that's right. And look, that's, to be frank, in an environment where we haven't been able to jump on a plane and go there. I think when we can get there in the next few months, we'll see that increase significantly. The other day I had a guy from KKR call me. I thought, that's interesting. Maybe they want to buy Removery or something, and he actually wanted a job. So, we are getting. It's great. We're on the radar. And I think, and look, Elliott. Jeffries, who we're our advisor for the Removery deal, have been fantastic, and we're starting. They've both, their principals have invested in the fund, and we're starting to see some opportunities come from them as well. So and some bloody good ones, I have to say. So it's interesting.
Just on that, Martin. Sorry.
Okay.
No, I was just going to say just on that. So we've actually got a question that's relevant to it. So what's sort of your target IRR with the fund? And you touched on this the other day, Martin.
Yeah. Sure. So the target IRR is a 30% post-fees return. So what that means is, on a pre-fees basis, each of our investments needs to be a 38% IRR business case, and that's on our conservative sort of base case assumptions. I suppose what we're really looking to deliver for our investors is a 5x, 5y, so 5 times your money in 5 years type of return.
Yeah, and the other day you were saying probably 10 to 15 of these deals out of the 90 that you looked at were probably in a wheelhouse of a 20 to 25% IRR, which is obviously still highly attractive, but it didn't meet that requirement.
That's right. We're seeing some great deal flow. We were engaged, for example, on a really high quality opportunity, an Australian edtech company, in December last year. And we were like, this is a no-brainer, 20-25% type IRR. And our base case was around 26-27%, and we turned it down on that basis. It was below our threshold. So, really good discipline, I suppose, to focus on delivering those outsized returns.
And you mentioned a return profile there of 5 years. So the plan is to have the fund fully harvested and the asset sold down 5 years from now, or what's...
Yeah, so I think, we've got a traditional 5 year plus 5 year sort of fund cycle. Yep. So again, most funds, would raise a blind pool, would take them 3 or 4 years to invest, and then another 4 or 5 years to realize, and sort of take that whole 10 years. I think, we are different in that we are launching with a portfolio existing on day one. Our best guess is that we will be fully deployed, so fully drawn down on the ordinary units in the next 12 to 18 months. And so theoretically, that obviously brings forward, I suppose, our liquidity sort of timeframe. So, best guess is that we'd be looking to exit investments between year 4 and 5 and 6, maybe some earlier. But if we're on a dental corp winner, as Mark was describing, then we want to ride that, fully until the end. So if we've got a business, compounding 30% year on year, top line every year, then, we want to hold it for 7 or 8 years and really maximize the value return to investors. And I think the other key point to mention as part of this is, as we exit each investment, we return the money to investors at that stage.
Okay. And that is a key point, that you're not looking to redeploy that into other investments as each investment crystallizes. There's capital return coming through.
And I think the other point, maybe just to touch on from a fund perspective, is the advisory committee. So we've been very fortunate, I think, to have attracted some of the preeminent names in the heal sectors. So Rod Jones, the founder, chairman of Navitas, one of the largest education pathway companies in Australasia. We've got Chris Rex, former CEO of Ramsay Healthcare, who was one of the preeminent leaders, obviously, in that space. And then we've got Kathy Reed and Stuart Giles, founders of Icon Cancer, one of the biggest cancer groups in the country, which has now moved into Asia as well, amongst others as well. And so, they're very active in terms of, us bouncing ideas off them, our thoughts on investment opportunities in terms of deal referrals, and they're all investors into the fund as well.
Right. I think it probably covers off most questions for myself and investors. Guys, is there anything sort of final comments or anything you'd like to further add before we close things off?
I think from my perspective, I mean, the point I'd like to make is that we're investing here in real businesses that we believe we can add value to. And, I think we'll continue to do that. As far as exit strategies go, our exit strategy is build a fantastic business, and there's always someone who wants to buy it next time around or invest in it or take you out and grow it. And, I think that's what we're good at. We focus on building fantastic businesses. We focus on our customers, and the rest sort of, as I say, doesn't look after itself, but it certainly goes a long way if you've got that mindset. We're not trying to just leverage up some assets or buy cheap and sell high. We're actually trying to build great businesses on the way through, and that's really our focus.
Sure. No, thank you, and well said.
Another question here, Anthony.
Just came through, yeah.
So just in terms of the fundraising side of things, so we've targeted $100 million with the right to take over subscriptions. We're currently at about $65 million of commitments, and obviously numerous other conversations ahead of first close in the next couple of weeks. Minimum ticket size is 200,000 Aussie.
Thanks, Martin. So if there's any other further follow-up questions, I can take those offline and send them through, guys. But look, really appreciate your time today. It's a fantastic story. Congratulations on the success so far, and we look forward to joining you on this going forward.
Thank you.
Appreciate your time, Anthony.
Thanks, everyone. Appreciate your time.
Thanks, guys. Cheers.
Bye.